Hey folks, and welcome to the Pipnotic Symposium on the 1st of July 2023. Okay, so today we're gonna take a quick look at some of the stuff that we've been building on over the past couple of symposium. That is identifying assets that are ripe for trading, because not all assets are ready to be traded. Of course, you can force things by going onto the smaller time frames, but then you're ignoring or potentially ignoring the flows on the bigger time frames that are likely going to cause some emotional pain at some stage. And so what we want to do is we want to try and focus on some things that are profound relative to the way price moves. And so if we look at a price structure like this and we compare it to what the histogram is looking at, we can see with a very high degree of accuracy that when prices move to an extreme, we're seeing prices move back into, it's not a very good example, we're seeing prices begin to move back into a range. And I'm going to choose the ones, okay, where prices are already starting to move back on the histogram, just so that we can time this, just show the timing. And it went back, I think, guess around here. And this one here, maybe around here. Okay, so what they're showing us is that they're showing us, or the histogram is showing us very clearly, that we are experiencing turning points. Okay, and this is really valuable information. Let's draw these off a little bit, like so. So what we're seeing is that the histogram is telling us when these cycles are complete. And if you've been watching some of my older symposiums where I talk about cycles of pretty much anything, cycles is something that really occupies the way I think. And I mean, even in a conversation, you're having a conversation with, for example, I'm in Denmark at the moment visiting my parents-in-law, and my father-in-law loves to debate and have discussions. And even in our discussions, the conversation operates within the confines of a cycle. And that may be a little bit weird, but typically the conversation will commence. Okay, so we start here. This is where we start. Okay, and let's say this is where we stop. Okay, actually, let me use a different thing so it's prettier. Okay, so we start the conversation here. The conversation or discussion or debate or argument, start, stop. So it starts here. So when we begin a conversation, we're typically engaging in a conversation or a debate because of a disagreement in something. And this something can be politics, it can be ethics, it can be pretty much anything. And so initially, there's going to be a deviation. So let's say that we're very far away from each other when we begin our conversation. And typically, this is about as far away from agreement we can get. Okay, so it goes like that. But this disagreement in my conversations with them doesn't stay up here. Normally, we'll reach some kind of a consensus or an agreement, at least on something within the context of the topic we're discussing at some stage. Okay, and so if this is disagreement, and this is complete agreement, and this is disagreement, so we have a positive and a negative deviation from agreement. Okay, so we start here. We're really disagreeing. A really good example is this neoliberalism is forcing me to be quite conservative. Although I've always been really liberal, I find myself running towards conservatism because I find, at least for myself, that there's a bit of a disconnect with those values. Okay, and so maybe he's on the other end of the spectrum, which he isn't, but let's just say he was, and so there's going to be disagreement. Okay, but we're gonna eventually reach some topics that we can agree on, or some aspects of the topic that we're discussing that we can agree on. Okay, and so it'll slowly start to verge. But then we'll reach something else that essentially causes our conversation to once again diverge. And it looks a little bit like this. Okay. And this is from the beginning of the conversation to the end of the conversation. But we can also have some within that macro cycle that makes up the debate or the conversation as an entirety. We can have some micro disagreements on certain points within the context of the topic, and so it can go like this. Okay, look like that. So disagreeing. Okay, yeah, that's right. That's right, father-in-law. It goes like that maybe. Okay, that wasn't very good. It should have gone. It should be. There we are. So it lines up. Okay, so it could look a little bit like that. Okay, and so conversations is just one thing that you can experience cycles within. Okay, this is the conversation I'm quite acquainted with, being here in Denmark at the moment, and it's fascinating because this whole concept of cycles applies to absolutely everything. Okay, and so what we want to do for trading, we want to focus on the same stuff. Okay, it's the same theory essentially. We're looking from um, extreme divergences and convergences in the prices of assets. Just like debates, there can be extreme divergence from particular points within the context of the discussion, but there can also be convergences where we agree on certain points because for whatever reason. Okay, so we're using the same thing over and over again. You can also notice it when I'm sitting here upstairs at my parents-in-law house looking out the window, and I'm looking at the beautiful trees as they sway in the wind, and it's a little bit gray and windy at the moment. But the trees, I mean, the trees are affected. Let's say that this is a tree here. So this is when the wind isn't blowing, but the wind can blow from this side, let's say from the east, cause a tree to go here, and it can also blow from the west and cause a tree to move here. And so there's constant movement between the tree. It's going back and forth, like this, the whole time as the wind continues to develop and move, in the same way that conversations do. Like so, agreement, disagreement, agreement, disagreement. And so, knowing this and having this insight alone is very empowering, because we know that everything in nature, be it a conversation, a tree, temperatures, wind, everything operates around some kind of a normal behavior for whatever it is that we're observing. So if I remove this and we move back to our asset prices, we're seeing the same thing here over and over again. And here they are. They look like this. Negative divergence, positive divergence, negative, positive, negative. See, so this is the market conversation. Okay, it looks a little bit like my conversation with my father-in-law, like so, doesn't it? So we have our average price, which is maybe in the middle, and we're simply moving between those extremes. Sometimes we get negative standard deviation, we move back to the mean, have a positive standard deviation, a negative, move back to the mean. Okay, and so what we want to do is we want a way for us to see when we have moved outside of the expected behavior for this asset price. And this will typically happen when the histogram is moving to the extremes. This is an extreme, but just an example, like so. Okay, this is super interesting. And at the time that this was formed, we didn't have these extreme deviations. Okay, and so maybe these lines here were in fact much closer. So this was probably a negative deviation, because these big swings here push these bands, the positive band and the negative band, further away from the mean. Okay, and so at the time, this was pretty negative relative to the price rather relative to the readings prior to it. And so all we want to do when we trade, we want to do something super, super simple. We want to know when prices have a slightly higher than expected, rather a slightly higher probability of doing one thing relative to another. Okay? And this is most likely to happen when we are operating at these extreme levels. So when when I'm having an extremely disagreeable moment with my father-in-law because we're discussing politics, then I know that we can only begin to move closer to each other. Okay? So when the markets are super high, we're in like a super deviation from a mean, which is here, this being a positive one. Here we have a super low price, which is a negative deviation, once again, from the mean. The only thing that we can do within a reasonable degree of probability is move back towards the center. Okay? That's the only reasonable thing it can do. And the one reason that the one thing that gives me confidence in my decision making is because I have an understanding of what causes these prices to move up and down. And that thing is the understanding of how liquidity is distributed in a market. Okay, and so if we go back to the canvas here and we draw our beloved order book that we talk about so much, we have, okay, so this is the bottom of the book. Bottom, bids. Here we have top, offers. Okay, so here we have the top of the book. These are high prices. These are low prices. So what we can expect to do when prices move up and they towards the top of the book, who's going to be looking to do what at these very high prices? They're going to be looking to sell. This is such a high price. We want to sell at these high prices. I have inventory I need to get rid of. I want to sell. Okay, and this is often where the histogram will be doing this. Will be up here. At the top of the book, the histogram is going to be beyond that line that you can see. It'll be up here. And so the most reasonable thing, the most probable thing to happen will be for prices to begin to move down. And the reason that is the case is because at very high prices, buying is going to disappear. The buying power for an asset is going to disappear the higher prices get. Unless you're operating in incredibly unreasonable markets like the crypto markets that we've seen, when people simply lose all sense of reality and they think that the markets are going to continue to go up no matter what. And they will for a little while because everyone seems to agree that they need to get their hands on some of this quote unquote valuable asset. But because of the way the market works, it is simply not sustainable. It's simply not sustainable. Okay, so around here, prices are up here. And as we get to the bottom of the book, we start to increase the number of buyers who are looking to buy. Okay, and then we're down here. So the histogram will have been beyond that line, the sell line, the green line at the top. And at the bottom of the book, it's going to be below the red line. Okay, and so what the histogram is doing, it's telling us whether we're up here or if we're down here. And if we were up here, what do? Well, then we sell. If we're down here, what do? We buy. It's super simple. And so essentially what I'm trying to tell you is that I want you to pay attention to the histogram. It's not just a normal oscillator, squiggly line indicator that is on your chart for entertainment purposes. It is showing you something very, very profound. So I want you to start to pay attention to it, because once you do, everything will change. Okay? It's a really, really valuable tool. And I know people that only trade using the histogram. They use nothing else. Okay, they simply look for the histogram and doing something like this. I mean, look what happened when prices were very positive and they started to go negative. I mean, that was, let's draw this. Let's go from the minute it went positive to the minute it went negative. Okay, and when did it start to go negative? Right here. Right there. Okay, so this is the 4-hour chart. This is the 4-hour chart. It can be difficult to know what's going on the 4-hour chart in relation to micro price movement. But even on this chart, what you can see is that you can see this little price structure. If we explode it and put it over here, we can see the big price run. See prices go down. We go up. We go down. This is a very important pattern. So we're down here, and then we go up, and then we go down once more. Okay, and you can see that here. This is a big price on the blue candle. That's this one here. The red candle, that's this one here. The blue this is the red candle. This is that blue candle that goes a little bit higher. Okay, it goes a little bit higher than the red candle. We go up here. We come down. We go below it. The blue candle. We go here. And then we have another blue candle with a wick. What's that? Well, we open here. We go up. And then we close here. Okay, so this is essentially a candle that looks like this. We open. We close. We open. We go high. We close. Okay, so the open is a little bit below the close because it's a blue candle. But this is telling us what? This is telling us that we have the pattern, the shakeout pattern that we always see, or very, very often see at these extreme situations like these. So what we can see right here is boom, 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 boom. Okay, and so what this is many things. This is actually many things going on. This is actually telling us that we have liquidity exploration. We have this high that is violated by this high. This releases liquidity into the market. So all the people trading on the 1 minute and the 5 minute chart, they have absolutely no context of what's going on. But looking on the 1 hour, the 4 hour chart, we know what's going on. We're running prices higher at a time when prices should be looking to move lower because of the histogram. So this then becomes what? Does it become a breakout? Absolutely not. It becomes the opposite of a breakout. It becomes bait to get people off the sidelines, invested in the market, so that they can do what? Hit their stops that are here. So all that liquidity is dumped into the marketplace and used to fill the positions of the people who are looking to sell at a reasonable price at a top in anticipation that prices move lower. Okay, so now let's go and look at the price chart. I'm just going to box this off, this whole area here. Now we'll go and have a look. Actually, we only want to see from this candle. Okay, then we'll go and have a look on the 15-minute chart, which is a great shorter term chart for entries. You have to go all the way back here. Okay, so here we can see exactly what we spoke about. And go up. We form that low. You go beyond it, so it actually starts here. Boom, 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 like that. Okay, so we're actually doing that just here, where we form a high, again knowing that we have very extreme, we're very, very positive. We run above this high where we have stops, where we're looking for people to buy. They're buy stops. Sorry, they're buy stops. So they're buying their long here, thinking woohoo, and they're thinking great, I'm in profit. And then what happens? What happens then? We hit the top of the book, and what's sitting at the top of the book? I mean, we have some big players with big muscles. Sorry, I'm really bad at drawing. I wish I was better at drawing, but I'm not. We have big players here with huge muscles, very, very deep pockets, and they're looking to sell. So they put a lot of money on the table to sell up here. Okay, this causes prices to go down. So the people who bought here when price popped up, they're thinking, oh gosh, I'm at drawdown. What do I do? Well, the clever ones, they get out at a loss once prices comes down here and stops them out. But the other ones, they just hold on to their positions because they're hoping that their 5-minute or 1-minute price pattern was telling them the truth and the prices are going to continue to move higher. Okay, but eventually prices will do this, and then they will start to get out of their positions, which will add to the downward momentum that you can often see after price forms a top. When the histogram is in the sell zone, you'll often see these big sharp runs away from these high patterns that we can see just here, and then prices will really start to tank. Okay, so if we go back to the 4-hour chart, or even the 1 hour maybe, you can see this all starts to happen. This is a combination of people cutting their losses, people selling, and stops being hit. Well, I suppose cutting your losses is the same, but you can see the same thing happening here. Okay, and then we have the big moves lower. Then prices start to move down here, and this is not buying. This is just profit taking. Okay, and prices continue to move down. And then they start to stabilize at where? At the bottom of the book for the hourly chart. Okay, and so what can we expect? What do we have here? Oh, gosh darn it. We have another cycle. Okay, another cycle, a bull cycle. Okay, so what do? You do the same thing. Okay, so there's no pattern in here, so we wouldn't trade this, but you would look for prices to do something like this. Make that high, get people to sell, stop them out, make them scared, make them wish that they were selling at break even, which they would do when price returns here before it moves and continues to move higher. This again is going to happen at the bottom of the book, the buy zone. All right. So what we want to do as traders is that we want to look for these little price structures because they are super, super valuable to us. Okay, let's look at one more example. Let's look at something different. Let's look at Bitcoin, because we had a trade on Bitcoin. We bought on the daily chart Bitcoin. So I'll have to go. We bought down here on the daily chart. Look at that. You can see the area right there. The daily chart right there. So we go to the daily chart so we can see that. We bought right there. Right here. Okay. And we did that because on the smaller time frames, at that time, at a time when we were approaching daily demand, we're starting to do this. We're starting to do this. We're bottoming out. But notice as well that we go from the very deep to slightly deep to less to less. Then we have one last shake at the bottom before we finally start to move higher. And this all happened at daily demand. And then we saw this huge push away. Okay. But down here, you can see if we zoom in a little bit. This is a bit of a long video, sorry for that. So what we can see here, let's just mark this off. Actually, let me grab it on this time frame, if I can find it. I better go to the bigger one. Here. Put a box around it. 50-minute, zoom in. Let me go down and look. Okay, so here we did kind of a similar thing where we have prices go like this. We didn't have a proper run, which I'd have liked. Went here, and then we came down here. 2, we have demand. We know this is demand because last time price came to it, we bounced. So we have the buy zone established right here. Price poked into it, then we went up. Okay, super typical price behavior at whopping daily demand that we could see for a very long time. I mean, price, it was on there for many days before prices got there. It was put on the chart when this red dot was formed. So when this red dot was formed, we knew that we were going to buy here. Price goes up to this area of weekly supply. We gap down. We move up. We move pretty deep into it. We move down to this daily demand. Okay. And because of maybe some of the fundamental stuff that's going on around Bitcoin, if you're paying attention, which is BlackRock looking to invest more in, many of the hedge funds looking to invest more in crypto, and some other things. I mean, this would lead us to believe that prices are going to potentially wriggle higher from here. We do need to rebalance this, which we have not yet done. This one has more or less been dealt with, ish. This one has been dealt with. So now we're doing this. And this one we still have to deal with. Okay, and so knowing that, we would have a bit of an idea that prices are going to wriggle higher for at least a little while, and at least enough to get a trade on. And so the difference between an investor and a trader is that a trader is getting in and out of trades all the time. When there's profits on the table, they're taking them. Where an investor is simply buying and holding, which doesn't really make sense, because why would you hold something for an extended period of time when the value of that asset is depreciating? It doesn't really make sense. And so, I mean, here in Denmark, we have this thing called a børneopsparing, which is a kind of a savings account that you create for your children when they're born. And every month you pay like a few bucks into it. And over the course of 18 years, I mean, it should slowly grow into a substantial amount of money that your children can have when they move away from home, which I think I'll allow my boys to do when they're about 30 years old. And so, but when we came back, we didn't have access to our net bank, being in Denmark. Sorry, being outside of Denmark. And so we logged on for the first time in a long time. We could see that, wow, our kids' børneopsparing has really depreciated in value. And that's because the people who are investing, not trading, but investing in the money are looking on these huge macro cycles like this. And so this could be 1 to 20-year cycles, and they're looking for this, boom, boom, and they're looking for these huge moves in price, and they don't really care when prices go down like that, like they do um, during financial troubles. But a trader, what would he be doing in here? He'd be selling, 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 buying, 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 buying. And so my wife and I were looking at this thinking like, what on earth are we doing? So just holding the money in a savings account would have been more lucrative than letting the bank traders invest it. It doesn't make sense. And so we are traders, we are not investors. We're looking to get in and out of trades on a regular basis. So when you see a trade like this isn't, okay, cool, I finally got in Bitcoin, and we're not holding it forever. What are we doing now? Well, now we're looking for reasons to get out of the trade. Okay, we have sell zone here, price and efficiency here, and all of these things make sense to us now because we understand how liquidity flows in and out of a market, and we're using this to constantly adjust our expectations and our behavior relative to what we think an asset price is going to do. We don't know what it's going to do. We never know what it's going to do. That's what an economist does. They try to predict macro trends in economics, which is really difficult because you have pandemics, you have wars, you have this, you have that. There are so many different things. And so as traders, we don't pretend to know what's going to happen next, but we can see what may very well happen over the course of the next X number of hours or even days if we're looking at like slightly larger time frames. Okay, and so always be prepared to take profit out of a trade when it's available to you. Don't hold on to it and hope that this is going to be a 1 in a million, because it will not. A good friend of mine who lives in Copenhagen, we started our trading journey together in about 2010, 2011, and he had this trade on. I remember it was a pound American dollar trade, and he held this position on, and it was like 800 pips in profit. It was a huge trade, and he left it on, and this huge trade ended up moving against him to the point where he ended up getting much, much less. And that's because it doesn't make sense holding stuff forever, because the market, based on what we spoke about earlier, order book, liquidity, it's always going to go up and down. Conversations, wind patterns, asset prices, everything moves in cycles. And so holding on to something here and expecting it to go like this is unrealistic, and it's also unintelligent. And so we don't want to do that. Okay, because what happens if you wait too long? Yeah, happy, great. Oh my goodness! Oh, I'm so excited. Oh, I want to cry. I want to go vomit in the toilet. Oh, yeah. It's terrible. It's bad for your health. It's bad for everything. Your children are going to find you uncomfortable to be around. Your husband or your wife is going to as well. So you get in here, and if you get out at the mean, great, get out and be happy. You had a beautiful run. If it goes up here, who cares? You missed out on this, but what are you doing? You're preparing to sell. Why? The histogram's telling you that we're probably going to have a little run lower. What happens? We have a little run lower. Okay, so you get in here, you get out here. Great, had a lovely run. Oh, we missed out on this. What are you going to do? You're going to prepare to buy. Okay, good. So try and play it like that. Try and think of it like that. Okay, don't think that you have to know the answers to everything, because you never will. Just trade what you see. Use the tools that we have available. They're super powerful. Nothing in the Pipnotic tools that I've made is random. There's no random noise. Everything has been made for a purpose. Okay, the histogram is one of the most powerful tools that we have in our arsenal. Okay, so use it. Use it smartly. If you're not using the dashboard, then I advise you to use the dashboard, because all of the assets are listed there. And that could be a really good place to start when you're stalking trades. Okay, so you look for the trade that you want to sorry, you go to the dashboard and you only look for, let's say, 4-hour buy and sell zone trades, and you focus on them, like we've been doing on the Aussie dollar all week. Okay, and the other ones, and the Bitcoin, that was another example. So focus on those. Okay. Okay, well, I'm going to stop rambling. That was a long video. I apologize for that. But if you have any questions, please let me know. And thank you so much for watching. Have a good weekend as well.